Wolfgang works at the European Center for Social Finance, and he has significant experience in social finance, setting up investment funds, debt funds, but he will introduce himself in a minute, provide more detail. So let's talk a little bit about what SIFTA is. SIFTA is part of the InvestEU Advisory Hub. And here we have different windows. And under the social investment and skills window, we have a specific section dedicated to microfinance and social enterprise finance. This is where we are. So the EIB, the European Investment Bank, is in charge of managing the SIFTA program. And the main idea is to provide targeted capacity building, project advisory, and market development support to financial intermediaries who are active in the microfinance or social finance space. Basically, under SIFTA, there are two distinct services. One is dedicated, as I said, to advisory and capacity building, and the other one is dedicated to rating, assessment, and evaluation. So if you want to make use of any of those two services, your organization has to be based in the EU 27 in one of the EU 27 member states. The current budget we have provides funding until December 2025. More budget will hopefully be secured, and we will update you as we go along. So then who's implementing the program? As I said, the European Investment Bank is the lead and is managing the program. And then it will be the capacity development services, market development services will be implemented by Frankfurt School of Finance as the lead partner, with the Microfinance Center, the European Microfinance Network, and FIBEA. And the rating, assessments, and evaluations will be provided by MFR. So I think we can leave it at that and hand over to Wolfgang.
Thank you, Jörg. Nice, good being here. Let me share my screen. So we are going to do two things today. So I have a presentation talking about the key fund terms. So what is important in setting up your funds. And I'm happy that Raphael is here, like something like a co-presenter today, because we've been working on a new fund for Crescesor over the last 12 months. And I'm looking forward for you, Raphael, to share some of your learnings along the way. And I've brought a model here where we talk about the steps in how does it work with the different management fee, performance fees. How do you manage the fund management company, and how do you project debt and equity investments? But let me start with the presentation first. So here we go. So as I said, we will talk about the general fundraising landscape. We talk about the key fund terms. So like, what does it all mean in terms of fund terms, in terms of net IRR, gross IRR? How does the discount rate integrate the impact your fund economics? And I was thinking that I can share the model via the chat, but I think we do it via email afterwards, so that you get everything after the webinar. A few words about myself. I'm working at the European Center for Social Finance at the Munich Business School. I have a background in engineering, but I think I've learned modeling working for Morgan Stanley in the investment banking division. So doing a lot of work on modeling all kind of cash flows and structures. Recently, I've written a few books about AI and blockchain for social impact investing, and I've submitted a new book yesterday on the operating system of sustainable finance. So about the different structures in sustainable finance and what you need to consider, what you need to manage, what are the data flows, what are the information flows. And in the last 10 years, I've worked with probably 25, I need to count it, but I guess 25 different intermediaries on setting up funds, modeling the funds, how can you model your equity and loan funds. And also I've been involved in setting up a fund in Munich a few years ago, and also some more academic experiences. Some of you have been here for the evaluation webinar last year, and I think it's quite important. Like one of the key takeaways was when you do your investments, there's one, so you do all kind of financial forecasts, but what is really important is what is the discount rate you're using. So, and I think just to show it here again is, so you have the stream of future cash flows. Let's see what year 1 to 8, and then you discount the future cash flows with your discount rate. And depending how high your discount rate is, it impacts how much you can pay for the asset. So, for example, if you say you have this business here and you need to generate 20% IRR for your investors, then that means that you can pay 10 million for these cash flows. A few funds, they would go as high as, say, we use a discount rate of 70%. Then you would pay like, I don't know, like 2 or 3 million for these cash flows. If you say you can be more flexible and you don't need to generate as much return for your investors, for your limited partners, we come to that, then you can pay like 24, 25 million for these cash flows. So this is important. Depending on how much you need to generate for your investors, you can use different, you can pay different values for the cash flows. And of course, if you are in the social economy, it's better if you can contribute more capital, if there's more, if you can be a bit more flexible. And this is something what is at the core of our activities. And for example, if you do some kind of community-based social innovation, you cannot expect to have like 10 to 15% IRR. You need to have like cheaper sources of capital. So this would be like lower. If you have any questions or comments, just jump in and share your comments and views. And as I said here, it's the discount rate, which is important for your fund. And good to see Pedro here as a corporate finance expert. Depending on your discount rate, it depends on what you can invest in. And I think this is like the main case. So, for example, if you do, so when you start building your fund, so what you do is you define what you want to do. So you define, are you doing equity, or are you doing debt, or are you doing any other form of finance? I don't know, like hybrid finance, where you have some kind of mezzanine combination of debt and equity. And then you say, so for example, I'm working now with this fund in Singapore. They're doing education with equity investment in Southeast Asia, with a return of 12 to 14% in this range. So this is something what you can offer. And then if you say, I do education, equity, and can offer this return, you look for investors who are aligned with these targets. If you say you do microfinance in Portugal, and then you can realistically offer 2 to 4% return, so that's what you want to offer to your clients. Then of course it's like a different set of investors than if you go for higher returns, or if you say you do general impact in Germany and you have like high single-digit returns, then you would again look for other returns. And I see, I also see it in the membership of the European Microfinance Network is like you have all kind of different returns, and you have like you can offer different things. So for example, you can offer euro investment, you can offer in Romania lei, or in Sweden krona investment. So it's something what you can change. Then we have all kind of different returns. So for example, in Romania, you would have like higher returns than, for example, in Southern Europe, where you have like where you would need to target like lower returns. So just to be in line. And this is what is happening. So what you do is you go to your investors, and then you start speaking with them, and you start to identify the set of investors who you want to target for these as your limited partners. And then once you have achieved that, and I think that's also one of the key challenges, like knowing. So, for example, what you need to consider is that out of 100 people you speak, 2 to 3 will invest in your fund. So you need to speak with a lot of people to get to your fund volumes you want to raise. And then once you've closed your fund, then you start investing according to the profile of your to the return expectations of your investors. And just to show you a few examples, like how different it is. So this is a German fund which is investing into African agriculture and forestry. So they have commitments of 27.5 million. But what is interesting here is again, and that's something what we can do in the fund modeling here, is that the team has committed to invest 1 million of their own capital into the fund, which means that it's not very inclusive sometimes. So that if you want to set up your own fund, people sometimes expect that you contribute like significant amounts of your own capital in this fund. And what they say here is again here, can you read it? Yes. So they are expecting here net IRR of 24% per year, which is quite high for impact for the impact sector. And what you have here is the fund term. The fund has a lifetime of 10 years, but they can prolong it 2 times for 3 years. So in principle, it can be up to 16 years. So they put in the costs, and also something what we see here quite often is the performance fee. So what you see is they have like a 20% performance fee, which is only payable if they have more than 10% IRR on investments, which is a good deal for the investors. So saying that I don't pay any kind of performance fee if they don't reach the 10% IRR. And of course, they also talk about the reporting and what they want to do. Just jump in if you have any comments or suggestions. And also something what is here, the capital calls. This means when, so the fund has a commitment of 27.5 million, but investors are not paying it at the beginning. So they're just paying it when the capital is needed. So there's a capital call, and then once you send them a notification, they are expected to wire the money to fund the projects. Let us go to the next example. So this is also interesting. This is a German impact investment fund for the renewable energy space. And what they do is they do all kind of photovoltaic plants. So they combine agriculture with solar energy and work with the Austrian and German railway associations. What they say here is their target net IRR, so what they expect to pay to the clients, to their investors, is 8 to 10%, so significantly lower. But again, you see like the differences, and the next example would be like 2 to 4%. So you see like this range of return expectations, or the spectrum of returns in the space. So we see here investment period of 4 years. The fund term has a maximum of 12 years. So it's 10 years, plus they can make it longer twice. And in this case, the carried interest is 20%. And again, here, what you do is you have like a 2% management fee. And just to give you some dimensions, so they say you have a target fund size of 100 million, with a management fee of 2 million, which means they have like 2 million per year to cover their operations. If we go to the first example here, the 20, let's say 30 million. So in this case, they have 600,000 euros per year. Now management fee is lower. Yeah. So it's about 500,000 per year to cover the management fees, the management expenses. And it shows that you need to have like a certain fund size to be sustainable. And that's why we also see like a certain upward trajectory in the space where funds always try to increase their fund sizes to be sustainable and to have enough assets to have enough management fee to cover all your expenses. And there's also something what we are seeing in all kind of sustainable finance funds is that if you are below 10 million, it's hard to be sustainable, like cover all your costs, and that's or you need to be very lean in managing your organizations, and that's something why we see this tendency to increase your assets under management. This is in German, so sorry for that. This is the European Social Innovation and Impact Fund, but I can show you the main topics here. So they have a target volume of 20 million. Again, a fund term of 10 years, plus 2, plus 1, plus 1. And they have a net IRR of 4%. And 1.5% depending on the risk profile. So they have a EIF guarantee for the fund, and then that's what they're offering. I mean, of course, so we have three different funds now. So one with 20, how much was it? 24. One with 8 to 10, and one for 1.5 to 4%. So it means that all of them create impact, but of course they have like very different profiles for the investors. So we have equity, we have equity in Germany, we have loans in Germany, and we have equity in Africa. So it also shows like so it gives like investors have like a range of like a menu where they can invest. And just to give you some more examples, so I have access to private equity platform, so where they show all kind of private equity and venture capital funds. It's always interesting to see like what are typical returns in the more traditional private equity and venture capital space. So these funds have typically returns of 10 to 30% realized. So it means over the last funds, they have managed to have always IRRs in this range. And there's also something what we are seeing in the market is that the larger asset managers, they have like a pipeline, a locked-in pipeline, where they have a preference for these kind of funds. But the good thing in Europe is that we have a lot of asset managers and family offices. So we have like a large pool of asset managers. And Europe is still the largest asset base for sustainable finance and impact investments and microfinance and social finance. So it's something where we are quite lucky to be in Europe. And we have a large pool of family offices and asset managers we can approach for fund investments. Just to show you another example here is, so this is another European private equity fund. So this is something what a typical asset manager can invest in if they're not interested in sustainability or in impact. So that's what they would typically be interested. Funds which have a track record of achieving at least 10, but usually more than 20% in the previous funds. The same as this one is a US fund, always returning 40 to 50% IRR, and also money multiples on the invested capital. Okay. And I think this is at the core of what we're discussing is that we have if you look at the risk of the impact funds in our space, you would expect higher returns, but the investors say that they are willing to accept lower returns in exchange for the impact those funds are creating. And I think that's something what we see again and again is that all these family offices are willing to accept lower returns in exchange for the impact. The other big school of thought is saying that some of them say that we go for the risk, for the lower risk profile. So saying that if you have some kind of ESG sustainability impact profile, your investments have a lower risk profile than traditional sectors. But in my experience is that fund asset managers and family offices and wise individuals are happy to accept low returns in exchange for the impact. And that's the thing, what we need to find in our spaces. We need to find those investors who are willing to accept lower returns. That's another thing we need to, what is happening, what we see sometimes in the French market is that you have a capital owner who gives an asset manager a mandate to invest. And so to maximize the impact they achieve by hitting a certain minimum financial return. It's not as common as the second one. So in this case, you're not going. So like the typical case is you go out and then you look for, so you share your value proposition to the investors and the investors say yes or no. And in this case, the capital owner says, I'm looking for an asset manager who can invest the capital for me and who needs to maximize the impact while achieving like 1 or 2% return. And just to give you the just to make once again the point like about the returns. So if you say you need to you want to achieve 20%, that means that you need to double your investments every 3 years. So if you go out and say, well, I promise you 20%, that means that you need to double the value of your portfolio every 3 years. If you say 30%, it means like you need to double it after 2.5 years. If you say 5%, you need to return 63 at the end of 10 years. So which is much more achievable and also better aligned with the impact mandate we have in our sector. That was the other topic before, saying that yes, we can also underestimate the risk of our underlying performance of our underlying assets. And for example, if you look at the default rates of banks, it's usually quite low. So there's something to it. But in my experience, it's usually people accept lower returns for their allocation. Any questions? Any comments? Then we can move to the next. To the next fund structures. So again, so this is like what I'm coming to in a second. So the split between general partners and the management company and the funds. So we talked about the internal rate of return, the IRR. We talked about the fund terms, so up to 16 years. And just to make it just to make the point again is, if you raise your funds, you need to get a bundle which is interesting for your investors. So there's no point saying that I do equity, I do high risk, but I only offer 2%, because that's not really attractive for the market. So you need to have something which is like a good portfolio for the which is interesting for the investors. And of course, people need to believe what you're saying. So that's another point. When we talk about fund modeling, we usually have this structure. So we have a management company, and the management company is advising and managing different funds. So we have the separation between fund management company and funds. And I had the discussion with Raphael. It's if you're a single entity and you're only managing, let's say, something like a cooperative or like a single microfinance fund, then you don't need this double structure. You can only do it with one fund, so that's fine. But if you say you're managing different funds, then you need to have like this structure where you have like one management company and where you invest different funds. And there's a few reasons why we do that. It's that you can say it's usually that you have a limited lifetime. So investors prefer to give you like the money for like 10 years. They don't want to give it to you for unlimited amount of time. So they say they like to give it to you for like a couple of years. And it's also something what people prefer, because you can say, I can do the investment managers, they want to do something else in their life. Maybe the performance fee depends upon like closing the investments. And if you say my fund closes, you can also have some kind of leverage or some kind of negotiation points with your investees. And in my experience, it's quite rare that capital owners want to do evergreens, so that the that they don't get their fund back after a couple of years. But again, if you say you want to have like one fund with one very specific field, then you can also do it with a single entity. But if you want to expand, if you have like a limited, if you have like different funds you want to do, let's say social innovation, microfinance, social housing, then you need different funds. And it's also easier to manage with your employees. So for example, if you say the fund closes after the investment period ends after 4 years, you would need to rehire the people in another fund. So in this case, you have like one management company, people work in a management company, and then they advise the different funds. And Pomventure is a good example here. Pomventure is a Munich-based impact fund, and they have started in 2003. And they started with 5 million. The second fund was 10 million. The third fund is not really public, and the fourth fund is 50 million. And it shows that so over the last 24 years, they had 20 years, they had like 4 different funds. So it means every 5 years, they need to raise new funds. And it's also quite attractive here in this sense because you see this upward trajectory saying that you need to increase the volume of your funds. And what you also see here is, for example, that you need to invest into larger tickets. So, for example, if you say a typical fund invests into 20 companies, in this case, you have the first fund did like 250,000 euros for each investment, and the current fund does already like 2 to 3 million per investment. So it's really like a change in what they invest and the scope and the investment sizes. The same can be observed for another Munich fund, which is which has the same trajectory. So they started with 7 million in 2008 or 2009, and then they have like 108 million in the last fund. Adrian was asking about the follow-on investments. If you look at Pomventure here, so they have 50 million. So what you would say is, my guess is that they would do like 60 or 70% in the initial rounds, in the initial investments, and keep some of the capital for follow-on investments. There are two implications. So the first one is those funds typically have like a lifetime and investment period. And let me go here. Where was it? So, for example, if you look here at this German whale solar energy fund, so they have an investment period of 4 years. So that means they can only invest in the 4 years, which is outlined here. And in the 4 years, they need to do the initial investments and any follow-on investments. So if you are at the end of if you're at 3 years, then you need to invest a bit more. So it's always like a bit how you also manage your pipeline, and you would reserve follow-on investments for the earlier investments, but not for those you would do at the 3 or 4 years stage, because it wouldn't be part of the investment period. If this answers your question, Ariane. And again, if you look at the German at the German funds, we have the interesting thing is we have 7 funds in Germany, and no 8, no 7 funds, and 5 of those funds have been created after 2020. So it's really like it's a really like a first generation. It's still, and I think that's also one of the issues in our sector is that people don't really know about the track record of the funds, because to close, because you need like 8 or 9 years to really know like what was the IRR of the funds, because you invest and then you need to wait for a couple of years until you know like how well it really performed, and then you have some kind of uncertainty in this field. If we go below, so this is also something what we see here is you have the management company. The management company is advising the funds, and the fund is then investing into the enterprises. So it is like the typical structure. And let us make it a bit more complicated now. It's so this is like the typical structure. You have the limited partners here, the LPs. So the LPs are those who are investing or who are providing the capital to the funds, and those LPs provide the capital to the funds. And we know that so they provide the capital, but they also pay a management fee to the general partners. So the GPs are those who are managing the funds, and the LPs are those who are providing the capital to the funds. In some cases, LPs make co-investments. So that means that they invest into the enterprises directly as well. So that's something what we see as well. And then, of course, what we see, the funds pay out a return on investments. So that's what they pay so the cash outflows to the limited partners, and the funds also pay the performance fee for the funds. Technically, it's the fund who is paying the management fee, but it's like it would be the same. So they provide capital to the funds that they pay the management fee to the management company. But the main idea is that the limited partners pay the fees to the management companies. Any questions? Any comments? All good. Okay. Or just put any questions in the chat as well. And then something what we see also quite often is who is actually paying for all these things. So we have like 3 entities or three how should I say, or like it's like a negotiation between 3 different entities. So you have the limited partners. So let me put it differently. There's the case that enterprises need to pay for the impact due diligence. So the fund is doing a due diligence, but who pays for that? And then you can say, well, you do the due diligence, you pay it for yourself. So the fund needs to pay it. But then what we see is that the enterprises have to pay these funds as part of the fundraising. So that the fund says, yes, I invest, but you need to pay for our due diligence costs. So this is something what you can say is some kind of a power dynamic between the different actors. And the same thing is like what is the carried interest? So what is the performance fee? What is the management fee? How much are we accepting how much do we accept in terms of fees, in terms of costs? And this is also something what we see as part of a as a dynamic between like the negotiations. And something what I quite like here is this, because this is like an extreme example. So this is the best performing fund ever. It's the Renaissance Capital Fund. And what they do is, and this is quite impressive. So what they have is they have returns every year of 70% or 80%. It's not impact. It's like a hedge fund. It's a quantitative hedge fund in the US. And what they do is they have like 80% every year for like 30 years. So it's really like a long track record. And if you're that successful, you can charge whatever you want. So in this case, they say, well, we charge 5% management fee, which is like unheard of, and we charge a performance fee of 44%. So this is like this just shows the power dynamics in this field. So if you have that high returns, you can charge anything because people want to be invested in those funds, and they accept pretty much everything. And if you look here at the net returns for the investors, it's still like in the range of 30 to 40%, which shows like that there's like this negotiations potential. Adrian, for your questions in terms of the due diligence, so what I see is that that many do like the due diligence only after the investment. So which could be improved, but typically you don't have that much time in the first phase. So if you say, I want to invest, and then you do some kind of like you do it as yourself, but if you want to have some kind of life cycle assessment, if you have like some kind of deeper impact analysis, it takes time which you don't have in the time between like when you negotiate the investments. So and then sometimes you have like other investors, and it's just not feasible to get it done before the investment. So in this cases, it's afterwards, and they only pay the due diligence costs if they receive the funds. Otherwise, it would be a bit strange. So nobody would really say, "Yes, I'm happy to pay for these costs," knowing that they are not going to get funding. Okay, let's move on to the next slide, and then we come to the model in a few minutes. Rafael can share a bit about the Portuguese examples, then about like how much it costs to set up like funds in Portugal. But what you have is you need to have some kind of legal structure and documentation. So every country has its own regulation for investment funds, and you need to follow those investments. You need to have like this limited partnership agreement. So it's a partnership, the agreement between. So there are many relationships you need to manage. You need to manage the relationship between your investors and the management company. So there's like this the agreement between LPs and GPs. You need to set up like the articles of the fund itself. So how do you manage the account? How do you invest? What is the investment committee? How do you take decisions? How do you manage conflicts of interest? So there are all kind of questions you need to clarify. So legal fees, I would say it's hard to imagine that it can be below 50,000 euros, depending on the pro bono and your network of lawyers and legal experts. But it's usually in the range of 50 to 100,000 euros. And then some of the new funds want to comply with the Article 9 of the Sustainable Finance Disclosure Regulation. So where you need to follow these SFDR regulations as well. And then you also need to register your fund. So this also adds to your costs. And what many are doing is, so for example, the ISIF as well as this African Agriculture Fund they're using a third party to manage the funds. So they have an appointment fund manager. So it's like they do all the regulatory stuff, and then you can focus on the pipeline, on the investments, and the management of the investments. If you do it yourself, I mean, of course, you need to have like the management company. I mean, you just know it yourself. So you need like 2, 3 investment professionals. You need to pay the salaries. If you are in Luxembourg, it's expensive. If you are in Romania, that might be a bit more, might be less expensive. So you have all kind of like regional questions as well. So how much will it cost? And then, of course, if you have like a third party, it can help to improve some of the costs. Then what we see as well is we have this fundraising is also expensive. So there's some placement agents who would take 1 to 2%, in some cases 4 to 5, of the investment. So they help you with the investment materials, with the investment deck, pitch deck, impact reports, and also with the investor roadshow. So you need to go to Frankfurt, to Paris, to London, and just Brussels, and just meet the main persons and see if they're interested in investing. And we were talking about the dynamics. So what we see is that some funds are charging a portfolio fee. So to be a part of the portfolio, you need to pay a fee to the fund investors, which is something what we rather see in the private equity space. Or they charge you like a monitoring fee. But it shows again like what is the relationship and like what is your leverage in the negotiations. And depending on that, you can charge different amounts to your portfolio companies. And then also something what we can see in this in the fund is that we have like this is how much you're paying in terms of management fee, and then typically you have like 2 different management fees. One is on the committed capital during the investment period, and the other one is the management fee on the deployed capital. So saying that, let's say you have a commitment of 20 million and a management fee of 2 million, you get like 400,000 euros in management fee. If you only invest 10 million in those 4 years, your management fee is reduced to the 10 million, and then you get like the lower management fee on the deployed capital. And then also something what we see here, it's the transaction fees. Lynn Daniel had a question on the placement agents. Where was it here? It really depends. So, for example, many funds are using a model where they pay a finder's fee. So they are paying 1 to 2%. So let's say you want to incentivize people to help you fundraise. And then let's say there's someone who can help you get funding from Allianz or from any asset manager, and then you would pay them a finder's fee of 1 to 2% for facilitating just for the contacts. So if you can give me a contact so they would say, I want to raise 100 million, and if you can give me contacts, if you can introduce me to people who will invest in the funds, they are willing to pay 1 to 2%, which is a good model for many people. So if you say, I help you to raise 10 million, you would pay me 200,000 euros as the success fee, which is a good model for all of them involved. So you can raise your fund, and then you can anyway put it into your setup costs, and it's something on a more individual basis. The other thing is that there are professional placement agents, which have like a business model around. So they work with 3 or 4 funds per year, and then they say they have a network of investors, and then they help you to set up meetings, to put you in front of these people, and then they would charge higher. But the thing is that they don't work with first generation funds. So they don't like new funds. So they want to say that you're like an experienced fund, you have some kind of track record, because they don't like the risk of working with inexperienced fund managers. And they typically want to have like 100 to 200 million as a lower fund size, just to make it more interesting for them as well. I hope that answers your questions, but it's about investors. Usually there's no payment involved for the investment opportunities. So some US funds use some kind of a scout model, but I've never seen a case where you would pay to get like an investment opportunity. Okay, this is the so just like also the only data I found on the transaction fees and the monitoring fees. So that the companies pay some kind of transaction fee, and some of them charge a monitoring fee to the companies, which is one way to fund everything. And this is an example of a carried interest or performance fees, where how you would do that. So, and then you would say like, what is the hurdle rate? So how successful do you need to be to get the funding? And then you would define how much how much have you how successful have you been, and then like what is the carried interest? In this case, it's 20%. But the catches up means that you are paid for all the successes. So it's also for the first 8% then. And what we see is like typically is that there's some kind of ESG social impact criteria used to get these to get some kind of alignment. Okay, let me share the. Let's go to the fund model. Jana, do you know if I can share a file in this in the chat?
I think you can. If not, you can send it to me and I can put it in the chat.
Or maybe I put the. I put it in the chat. Can you try to open the file?
Yeah. I opened it and I can see.
Perfect.
File.
Okay, let me share my screen again. So. And to your question, Raphael, it's yeah, the carried interest is like similar to a success fee, where you are only paid depending on if you're successful or not. Okay, let's go through our example here. So what I like to do is I have some kind of like, I would say let's do the next 15 minutes for the model, and then we have like 15 minutes for our Q&A, or for our general discussion. So what I like to do is, in general, can you see it? It's large enough? We should increase the font size. Okay. So just put in here the name, how it's called, then the what is the font size? So we are saying we have like 20 million. So that the 20 million or the font size is important to calculate the management.
Luísa, consegue me trazer o saco de água?
So
Ok, acabou de aquecer.
if you are so the management fee depends on the committed capital. So if you change the management fee, I can show it to you here. So you can change it here. So if you say what happens if you have like 4%, what happens if you have like 1%, then you can calculate your revenues here. This is another thing, the investment period, like how long are you going to invest into companies? And what is the fund lifetime? So in this case, we have 10 years. And this is important. So the management fee. And the second topic here is, when do we change the management fee to the invested capital? So that's what I was talking before. It's like at the beginning, you provide the management fee on the committed capital, on the 20 million, and then you calculate the management fee on the invested capital. So if you say you have raised 20 million, or you have committed 20 million in the fund, but you only invest 8 million, then you get only the management fee to manage the 8 million, which makes sense because that's the work you have to do. Then we have the management fee on the invested capital after 4 years, the hurdle rate, transaction cost, the carry, and the startup fee. What we do here is I've taken a model, a form where we say we have like 20 investments, and then you can choose, or you can do both. So you can either say, so this is something like the manual part, and of course you need to somehow model what you're doing is. So you can say we can do. So here you can add numbers for each investment. So you can say, I think my first investment will be 450,000 euros. It's in the months due. I will take like an 8% interest rate for 6 years, or let's say for 4 years. And then this is something what we can see here. And what we see here is that you have in the second month, you have the debt investment, and then each month you get 8% 8% interest rate for 48 months, and then I hope it works. Yeah, luckily. And then after 48 months, you get back the 450,000 euros. So this is something what you can do here. And the same happens if you do the equity investment. So the second one would be an equity investment of, let's say, 600,000 euros. And just to make it more simple, so like we do the cash outflows with a minus sign, and we do the cash inflows with a plus sign, which also makes it easier for our IRR calculations. And then we have, in this case, we say we do it after 2 months, and we have an exit event after 6 years and an exit multiple of 0.8. So it means that we are losing money. So we can look here. So we have a cash outflow of 600,000 euros, and then we get back the 480,000 euros in month 72. And this can be done for all of the investments. And you can change the interest rates, you can change the amounts, and you can also see here this overview, like how much is the total investments. And just to, I think it's obvious, but what you need to consider is that you need to have some room left for the management fees. So if you have like 10 years, you have like 1.5 to 2 million in the management fees. So it's something what you need to, so you can only invest like 7.5, 17 or 17.5 million in the companies. So you need to have some money left for the for the management fees. And typically what you would also do is, I think it's nice to have like both, but in reality, in practice, you would have only equity or debt investments. So you wouldn't combine both. In the early phases of the impact investment, we did like both. So people did like both because there was not too much potential to do equity investments. So therefore, people did like equity and debt because there was not too much opportunities to do equity investments. But nowadays it's like either or. And then what you do is we have this so what we see here is that the first thing is the management fees. So management fees, the first 4 years are done on the committed capital. So it's looking at the committed capital here, and then you can see the it's calculated here, and then afterwards it's calculated what we see here on the. So if, for example, if you change it to 4%, you see that the management fees increases to 800,000 euros. That's too high. Let's change it back to 2%. Raphael was saying last time that he was hearing about 2.5%. So it's like all kind of, they need to play around like what is feasible and what is done. And then after the 4 years, you change it to a lower management fee on the invested capital. Then you see all kind of, then you see the cash outflows. And this is also something what is quite typical for the private equity and private debt funds is that the first years you only have like an outflow of capital, and you only get back the you only make your it's what people call the hockey stick, so that you have like a J curve, so that you have like lower, so you have the cash outflow in the first years and also like lower returns, and then you have a negative returns, and then you have like the cash inflows only in the 7, 8, 9, or 10th year. So it's also something what you do. And just as a side note, people have a preference for secondaries, just to buy funds which are a bit older, because then the profile is so they can match it better with the other funds. So, and then asset managers like to have some kind of balance in their private equity placement, so saying that they want to have some which are young, some which are like more mature, so that you have a good balance of cash flows. So, and then what we do here is that we see all the investments. So, and then what I've done here is that you have for the first 20. If you want to have more than 20, just copy it and just add it here. But usually, if you do equity investments, it's usually fine, enough to have like 20 investments. Something what I can also share, maybe what we can share or what you can discuss in a future webinar, is like something like a Monte Carlo simulation. So like saying like, what is the amount? So because in this case, we are not modeling the defaults, but in every loan, in every portfolio, you would expect some write-offs or some defaults for the debt investments. So it's something where you would say like, what is my expected default rate in my portfolio? What is my loss given default? And then you would integrate it into your model. So we have the cash flows, we have the management fee, we have the startup fee here, and then we can say what is our IRR. So in this case, we have an IRR of 7.2%. If we want to increase it, we can just say, let's say we have an exit multiple here, not of 3, but let's say of 30. So if we say we get back at 30, so you see then we have like an IRR of almost 37%, because that would really change the composition. So, but then you can play around and say like, what do you need to, so this is a good exercise because it helps you to understand like, how does my portfolio need to look like in the long run to be successful, and to also get a performance fee. I see Imad has a question. So the average investment size is 500K. Yeah, so Imad, if you look here, so what we have is we have 20 investments with a total of 17 million. But your question is right. So it's really like at the core of our industry is like funds have this tendency to increase their fund sizes, and because people move from the seed and pre-seed or early stages to like A and B rounds, just to deploy the capital. So if you have like 100 million, you're not going to invest like 250,000 into a company. So you need to have like the 2-3 million to invest. And this is like driven by the fact that you have these high, that you have a management fee, and you can only do that much with the management fee, and you have a tendency to go for the higher investment sizes. But yes, if you have some kind of if you do a lot with your startups or with your companies, there are surely ways to increase the management fees to higher weights. I know one fund. I can't really share it publicly, but what they did, they had like 10% management fee, because what they did is they did a lot of work with small companies, and they did get like a subsidy from foundations saying, yes, I like what you're doing, it's important what you're doing, and therefore we give you like a 10% management fee, because it's important what you do, and we support it. And the fund was always negative, that's another thing. But it's like there are ways how you can deal with that. In this case, the performance fee it's simplified. It's in reality a bit more complicated, but let's take the simple formula here is that you take the 8.2. So let's say the hurdle rate is then, let's say, put it down to 4%. Then you can see how the performance fee changes. You get like 20% above a certain threshold. If there's a catch-up, you would get like 20% of everything. So in this case, you would get like another performance fee. And this is the important thing here, is that these funds, these revenues are then fed into your into the income statement of the fund management company, because the management fees are part of the income statement of the fund management company. And in this case, we see that you have revenues of like 400,000 euros for the investment period. And the tricky thing is that you need to manage your expenses with the management fee you have. And you see, if you have like 400,000 euros, it's not that much. It's a lot of money, but it's like not that much if you need to, if you have like rental expenses, if you need to have like 2 or 3 people, you need some kind of back office, you have legal expenses, and the legal expenses are quite low here. They're probably higher, but then in this case, I would say it's realistic. You have like 330,000 euros in expenses to get your the fund. Okay, I think I've talked enough. Let us go to some discussions here. And what are your impressions? Maybe Pedro, what are your thoughts?
For me, it's always a surprise to have IRR of 20%, 15%, 25% in legal businesses. Okay, that's my problem. Always with these kind of figures. And lately, when you talk about debt investment, you are talking in bonds issued by companies with impact, no?
I would say the 20%, or like, let's say I've recently talked with people who invest into the Caucasus area, so Turkey, Armenia, Azerbaijan, Turkmenistan, and they calculate with 70%. So they only invest if they have like a shot at 70%, and that's like their discount rate. And of course, you need to be like very interesting that they go there and invest into these funds. But I would say for loans, it's like the general example is like one 0.5 to 4%, or like microfinance is like in this range, like 3, 4, 5%. It's much lower. And there, like what we recently see is that there are many who use some kind of equity kicker. So they say we do that, but we want to participate in the success of the company. So they say they have some kind of revenue share or like participation if the company is being sold or whatever. Raphael.
Well, this model is much more. We have received. He has been assisting us on designing possible instruments for our case. And this model, of course, is much more complicated because it combines so many different variables. Putting aside the equity investments possibilities, how do you think the variables will change if we are talking about a loan fund, which has to split, has to deploy capital in many more deals of lower sizes? So how do you think that will affect your model? If you're talking about microfinance funds, I would say that they will award, they would approve, their pipeline will be mostly likely focus on smaller ticket sizes, smaller loan sizes to the potential borrowers, and many more deals, which means that then the due diligence, the credit analysis, all the paperwork will increase much higher. So I think this will require bigger management fees, and I wonder how the investors, potential investors, so limited partners, would look to what would be their expectations on financial returns.
I mean that the first, so I think maybe we talked too long about the first thing, but the point I wanted to make is that investors have like very clear expectations where they want to put the money, and they are looking at the bundle of investments, and then they say, in your case, let's say Portugal, Azorian Islands, and then what is the profile and what is the risk profile and the investment opportunity they're looking at, and then I think the bundle needs to be interesting, and and people are usually like, if you look at the debt market, it's usually debt capital markets, it's usually lower than for the equity capital markets for various reasons. But in general, I would say if you look at a typical equity investment, it's really a long way. So you need to, it's also more expensive. So if you say you do like equity investments, you need to find the investments, you need to think about the revenues, about the upsides, about the exit opportunities. You need to manage them much more actively. So you need to go to the board meetings, which you typically don't do for debt investments or for loans. So this is like a bit, you can be more efficient in providing loans. And then it's probably like a question like, what are investors willing to pay? So you can always say, I want to charge like 4%, but then are they going to accept these 4% or not? And I think that's something, what is the feedback from the LPs to see if they are willing to accept it.
And when you mentioned the landscape, the European landscape, the number of funds that are established and are in operation are more focused on the equity side or on the debt side, which is more typical. Because if I talk about loan side, they will compete with the banking, with the normal banking system, where typically the potential borrowers have their own experience. They have, the guarantee schemes will come into discussion for sure. Then the interest rate have to be compared with the normal banking system interest rates. So it's loan sizes, loan business is one thing, equity is another story, right?
Yeah. Yeah, I would say, for example, if you look at the asset allocation of companies, it's so there are different numbers. So usually if you look at the sustainable finance market, it's like 50 to 60% is equity. Because like the stock market is equity and it's like large volumes. If you look at the asset allocation of institutional investors, I've read this number yesterday, they have like 53% in debt investments, in debt financial instruments, which is like private credit or bonds in a way. And this is like, but I would say in my view, it's a bit more equity. But that is just like the easier financial instrument. And if you don't have for example, if you want to do like larger numbers and want to be more efficient, you need to go in the loan market. Any other comments, Imad or anyone else?
Maybe another one. Is it, you mentioned that the destination of capital which has been raised, let's say we can split in three, maybe theoretically in three major fields: microfinance, social finance, and impact investments. On your experience, which one of these three areas really concentrate or attract more funding from limited partners? Because I assume that microfinance is a total different story.
I mean, the biggest pocket of money is the whole environmental green field, green bonds. So if you look at like the green bonds and the volumes of green bonds, I think that's the largest market out there. And just think about everything about the Green Deal, about like the funding for renewable energy. It's just a lot of money in this area. I think microfinance can do more to attract private capital. So I think like the bigger institutional investors, they're looking at the private credit market and they're looking for opportunities for private credit. But it's hard to find good opportunities. I think microfinance can be an uncorrelated asset class for them. So saying that we provide capital for private credit, I think this could be something. And there are a few examples. For example, I'm working now with a Romanian microfinance fund who receives money from a Swiss asset manager. And I think those are interesting cases where you say, how can you make combinations like this? And I think it's just like, again, like the thing is you need to talk with 100 people to get like 2 or 3 investors. And I think that's something, but maybe the European Microfinance Network can facilitate is just like, who are the investors, reach out to them, show them like the investment opportunities, and to use synergies between the different members. But I would say it's like far from saturated. So I think it's like the share of impact on microfinance is so small in the total volume. It's I think there's like enough potential.
I have another question in the chat, Wolfgang.
Yeah.
From Stefan.
So Stefan, so you are working on maybe you can explain it.
Yeah, sure. Hello, everybody. Can you hear me?
Hi, Stefan.
Hello, nice to meet you. So right now I'm analyzing and designing a hybrid model between media for equity and media capital. And maybe just a bit of a context. For the past 5 years, I've been studying media for equity as an investment model across Europe and then across the entire globe. And we have documented many funds in terms of performance and also the deals. And then what I'm looking is to right now have media for equity or media capital. Both of them are basically the same thing, combined with cash. Because what we've seen is that usually the investments that are done purely media for equity wise also need some form of cash investment to run the creatives, to do the creatives. And maybe just a small description about media for equity is, in short, you have TV advertising, you have TV airtime, you have billboards, print, anything that has basically a context of attention, right? So that is basically packaged and then invested, if that makes sense.
Yeah. No, a good friend was working for ProSieben for this media investment fund, which was quite successful. Back then, I'm not sure how they're doing nowadays, but this was quite.
They continue to be successful.
Yeah. Yeah, my impression was it's like very consumer focused businesses.
It is. It's mainly D2C, yes. So the question is, if you had experience with such models, respectively, if maybe we can have a conversation about it, or get your thoughts about it. Like, what do you think?
Yeah, I mean, what we see quite often is that. Are you talking about the fund level or the enterprise level?
A fund level.
Fund level. Yeah, I mean, on the enterprise level, they are quite good at attracting third-party resources. So getting like all kind of free and valuable stuff. But let me think about it. So maybe we can catch up afterwards.
Yeah, definitely.
So, but your question would be, if you are a fund and then you get like in-kind services you can sell to your.
Yeah. I mean, selling, it's basically you have media, which is evaluated at the price market. So you could have, 1 million, 2 million worth of media, which is actually invested. And then in my situation would be that media comes accompanied by 100, 2,000, 200,000 or 500,000 of actual cash, actual capital. And those two packaged are much more powerful than media as a standalone investment. From a legal financial perspective, there's multiple ways of how to do it. You can do it from the books, directly from the media groups / corporate books. You could actually do the 1 million of media transfer, and then from the media, from the startup to the media, no, from the media to the startup, and then backwards. But those are like this example is not very practiced, let's say, in this space. What I'm just coming back and simplifying is what I'm looking into is just hybrid model between media capital and actual cash capital. I've seen it work quite successfully, especially with the Televisa Univision media group. They have managed to invest into 4 companies which turned out to be unicorns due to their investment. So I know it can be successful. We have the data and so on. But yeah, it would be interesting, Wolfgang, to talk to you about it, maybe even offline, and see how you could maybe
afterwards.
pitch in.
But I think the interesting part is here, like what I can think of at the moment is that you have some kind of services funds provide. So for example, you have like all this incubation and acceleration services, which is like an in-kind service. What I've also seen is, what is quite interesting is that some of them are creating like a back office where they're managing public research grants or public. So they manage the application process for them, which is also like what you do is like you provide services which makes you more interesting as an investor. So people say, and then there's something what I can do on behalf of you to get, like, if it's like a crowded market, it can be like a differentiating factor.
Mm-hmm.
Yeah, but let's talk afterwards about it. Interesting.
Yeah,
And
definitely. Thanks.
Jana, I think we are like 3 minutes over time.
I don't know if anyone else has additional questions. From my perspective, we still can spend a little bit of time. I don't know how you are in terms of time.
Yeah,
like
just one last question, if I may. How do you, in the case of debt funds or debt instruments, how would you consider in your model guarantee schemes? Because that will be a critical variable, is how can we guarantee loans to the potential borrowers, over the potential borrowers? Thank you.
I think it comes again back to the question of like if you present your fund to an investor, and then if you can say, well, yes, it's an interesting fund, and like investors might have concerns about the track record, about the risk, about the uncertainty, and then if you can say, yes, I have the guarantee, it's a much easier sell, obviously. So if you say, yes, don't worry because we have the guarantee and nothing can really happen, then it's like a much stronger value proposition you can do to give to your investors. I think therefore it's like, so we also did the evaluation of the social business initiative, and especially the guarantees are really like a game changer. So like many loans were just being feasible because of the guarantees. And then if you can say you take out a lot of this uncertainty, and then there's no way that you can really lose capital on the fund. So it's hard to imagine that you lose capital with the guarantee. Then you can then it's like a very interesting model for the investors. But again, if you say you have like, for example, in the case of Marcos, it's for the 1.5 return was for the guarantee. And of course, it's not easy to sell. So saying that I give you like I need your capital for 10 years, and I can offer you 1.5% with a guarantee. It's not an easy sell either. So it's like so you need to have like some kind of decent returns plus the guarantees. But I understand in your case, Rafael, you also want to have like an attractive offer for the enterprises. So you need to balance like if you're too expensive, nobody would take up your offers. If you're too cheap in a way, you don't find investors. So you need to find this balance between like and also for the fund management team, you also want to have some kind of performance fee maybe. So you also need to have like something what is like you need to find a good balance between like investees, management, and investors. Thanks for joining.
Okay.
Thanks for your time.
Thank you,
And then-
everyone,
Thank you very
for
much.
being
Thank you.
today with
Nice
us.
to see you all. Thank you.
Thank you. Bye.
Thank
Have
you.
a nice
Thank you
day.
very much for
Have
the
a
information,
wonderful
Wolfgang,
day.
everybody.
Bye bye.
Cheers.